welcome everyone to episode 5 of Top of Mind with Consilio Wealth. We've got an awesome agenda lined up today. I have an update on my 529 plan, or my son's 529 plan. How is going to make me talk about this today, so we can share the update with everybody. We also are going to talk about housing and months of supply. We've got a lot of good news actually in today's podcast. I know that we've been highlighting some of the bad news, and our hope is with all of this to sort of pull what this news actually means, because the headlines skew negative. And so there are more negative headlines that we're going to highlight today, but our hope is to help you all see the good news behind that. We're going to talk a little bit about some other sales idea, not sales ideas, but just sales, like consumer sales, consumer buying, that sort of thing. And then a few other things if we have time. Well, Hao, welcome back. It's nice to see you.
Always great seeing you.
How are things going in your world today?
Thanks, Chris. Pretty good. Pretty good. So last time we talked, we thought the Fed was trying to crash the market. They didn't crash the market. I'm using really, strong terms here. But the last Fed speak, we recorded the podcast days before, and I said I expected that the market to react, more pessimistically about it. And I know we're gonna be more optimistic, but that was actually probably a good thing. They finally listened to what the Fed's trying to do, which is trying to slow things down. And I think the data that we're seeing, regardless of the headlines, things are looking pretty good in terms of inflation, which I think is on everyone's mind, and what we're seeing.
Yeah. I remember last time it was, I believe it recorded right before that Fed meeting. And so, the next day they came out and the market fell like 3%. And one could say maybe the market got a little happy thinking the Fed would take their foot off the gas early. But, again, our hope for today is to pull out what is the good news behind all of the bad headlines, because essentially what we're seeing is that it's working, meaning inflation numbers are coming down, and less sales is actually a good thing. It helps prices come down and this sort of thing. So we want to highlight a lot of that today.
Yeah, we wanted the Fed to build back its credibility, which it lost right in 2021 when inflation was starting to flare up, and they said it was transitory, and they lost a lot of credibility. What they're building back here is, we're serious, right? Your expectations for inflation need to come down. So sometimes expectations become reality. That's why we view that as good news. The market did sell off and reacted in kind, but again, not the worst thing for a market to go down sometimes. That's actually a sign of a healthy market.
So let's actually start there. So this is a good place to start. So you had some data on housing inventory that was from the Fred site. Yeah,
the Fed has different wings, and Fred is the St. Louis Fed, and they collect all the data. And housing inventory is measured by months supply, meaning if we had no new homes to sell, existing or new, on listings, right? So if you're a buyer and there were no new listings, how many months would it take to work through all of the existing inventory? Does that make sense? All right. So in a normal period, existing inventory typically lasts 6 months. Meaning it takes 6 months to burn through all the listed housing offerings, right, on the market.
If no new houses were listed, it would take 6 months to sell everything, and then there'd be zero listed in that. Okay.
Correct. That's a sign of a healthy market. It's not overheated, and it's also not, in a dump, right? Like, I bet in 2008 to sell a home, it probably was 9 month.
Can you go back that far in that chart? I don't want to derail you, but I'm curious now.
Nope.
Oh.
I don't know why I can't. Let me. Yeah, the data is relatively new, the one I'm on. But right now, we had like a bottom, which is like one of the worst periods to buy a house was in January 2022. Seasonality, keep in mind, is a big part of it, where no one's moving in January. That's in the middle of the school year. It's the middle of winter. Who's moving in the rain or snow? In Sacramento, there's none of that. So it's just dry. And that was 1.6 months. That's unhealthy, right? That's way too tight. Meaning it's going to take 1.6 months to work through all the existing inventory. That's not enough time.
Which is why it was such a seller's market. You know, sellers could command whatever price. There's not enough buyers. So there's, you know, I know in our greater Seattle area, you'd have 28 offers on a home, on any given home. And that's what would push the price up so much. And so the seller had all the control in that instance.
Yeah. And if you're looking at that as a bottom, I'm using air quotes here for audio listeners. If that's a bottom, the Fed was actually pretty effective in communicating, hey, we're going to raise rates and we want mortgage rates to go up. What did mortgage rates do? Did they go up a ladder or did they just skyrocket up?
They kind of skyrocketed. I mean, if it was a ladder, it was steep.
Yeah, we talked about last episode how the market has a good way of pricing things in right away. Mortgage rates are a good example. It shot up to 5.8, nearly 6%. And it's kind of back there. Mortgage rates are pretty noisy, but it had its intended effects, right? So if mortgage rates are higher, potential buyers are being scared away, or they simply can't afford it.
This article here, just to jump in, the 30-year fixed rate, as of the writing of this particular article that I'll quote, which was September 8th, so yesterday, as of the date of this recording, 5.89% is what a 30-year fixed rate stands at right now, up from 2.88% a year ago. There you go.
And since that quote-unquote bottom in January 2022, the month supply is up to 3.3 right now as of July. We haven't got any August data, but I expect that number to actually stay flat because seasonality. Because, like, who's selling a home in
maybe
January?
We'll have seasonality this year.
In September.
Like we haven't, I know
normal.
This is region specific and the pandemic boom towns that we talked about last year, but also just a lot of big cities have experienced this huge growth in sales and people moving like out of the cities, you know, to the suburbs, those sorts of things. And so you've seen, like in the greater Seattle area, I think our numbers were 0.1 or 0.2 months of supply at the highest. I mean, it was just, so, you know, some areas are more extreme than these national numbers that we're quoting here. But regardless, this is moving in the right direction. Yeah.
And we're providing all this context because a lot of media headlines will say, well, home sales are crashing. Housing is in a recession. Well, yeah, yes and no, but look at what's happening to sellers. They're probably anchored to their old price and they could probably afford to keep paying their 2 to 3% mortgage rate, right? And rent out their home. They're okay. They're not willing to sell their home for less than what they think it's worth, unless they have to move.
Yeah, it'll take a while for that to sink in. I mean, let's pull out what you just said there. I think likely prices are too high. Sellers aren't, they're used to listing and getting way over whatever they list at, and now they're probably listing too high. All the data I'm reading is saying something like 70%, 60%, 70% of homes are having price reductions in many, many areas across the country. This is not bad news. This is good news. Again, the media focuses on the negative and they spin it so it's a negative. If we could instead flip that around, glass half full, then we could say, hey, homes aren't selling as quickly. Therefore, if you're a buyer, you now have a little bit more leverage. Maybe you can actually get an inspection and not have to wave your life away when you buy that house. Or maybe you can go in with a contingency and actually stand a chance and win because you're not going up against 28 other people in that home. So I think this is good news. This is saying that housing prices maybe not necessarily are going down, but it's just getting a little bit easier to buy as a buyer. I think the funniest thing with all this is that isn't this what not the funniest thing, that's not the right word, but maybe the most interesting thing, isn't this what we all were waiting for? Like, let's rewind the tape 6 months. And buyers were so frustrated with the fact that I can't get a house and prices are going up so fast. And, it's 25% a year in some areas. It's just, this is unaffordable. This is ridiculous. now that things are slowing, buyers go, I don't want to buy now. It's at 6% mortgage rates. I would suggest this is partially what we're waiting for, and that what we're in before is not normal. What we're in now is much more normal.
Yeah. And again, in another media headline we'll see is, or have seen, is home builders are slowing because of the prices have come down, so they can't really justify building a home. We mentioned it last time, right? You can't build a home and sell it for less than what you cost to build it. But let's just look at a level down. This is all part of the normalization process across the entire economy, right? We're picking on housing because everyone is so enamored with housing because they live in a house, right? And a couple of things with home builders stop slowing building, right? What do they need to build a home?
Steel, aluminum. They need drywall. They need cement. A lot of wood, lumber. They need appliances.
Yeah.
They need labor.
What was happening to all those things in early this year? The cost of all those things around, let's say January 2022.
Some of the highest costs that things were.
Yeah. Since the peak in, I'm going to say May, the cost of steel, aluminum, copper, and lumber down on average of 15, 20%. Lumber is probably the worst, where it's down like 30, 40%. And, just bringing in gas, because, I don't know how much gas is used to build a house, but gas prices are down 30, 40% from their June
gas
peaks.
Is probably embedded in the cost because it takes a lot of gas to get all the things to the house to build the house.
Shipment, right? You think about the goods, what about the labor? Right? We were in a labor crunch probably around January, February 2022. Right? Because all these builders were in such high demand for good reason, but that raised the cost of everything, cost of labor, cost of lumber, cost of copper, which are all coming down now because it's part of the normalization process. So these home builders like KB Homes or Pulte Homes or Toll Brothers, they can really get the supplies and inventory a lot cheaper. Labor might be a little more sticky, but that's good news for anyone who's buying steel.
Let me just quote a couple things here that you had. Right. So steel is 21% almost less than the peak price and 10% less than it was at the beginning of 2022. Aluminum is almost 37% under the peak and 14% less than it was at the beginning of 2022. Copper is 25.5% less than the peak price and 17% off this year. So less this year, 2022. Lumber, which has been really, really bouncy. Actually, I don't have a number here, but it's down. It's definitely down off the peak by my memory. About
the peak was $1,700. Yeah, $1,700.
It's down 68%.
That's 1,000 feet. Yeah, it's 588.
Thank you. Yeah. So just some numbers there. This is good news. So again, the messaging here,
things are cheaper.
What you're going to see in the media is, oh my God, prices are falling, steel demand and home buyers aren't buying and all the building and all this kind of stuff. This is good news. This is a sign that it is working, and recognize that what we were in was not normal, and what we are in now and moving towards is more normal. And that is a good, healthy thing for long-term growth for the economy. Yeah. Let's take it beyond housing. Who else uses, off the top of your head, aluminum and steel? For manufacturing cars, technology stuff, computers, phones. Apple just released their new iPhones. Appliances. So all of that is, there's metals, there's chips, there's glass, plastics, all these types of things. Yeah, and we don't have to think far for even us two to complain about how expensive all those things you listed were, right? When we expect we're seeing the cost of aluminum and copper crash in its raw form. What's that going to do for the manufacturers of all these goods that we thought previously were too expensive? Actually, I'm thinking about this out loud now. It could drive the price down, which could be good for inflation. It could also contribute better to profits, because what's the number one or number two thing that all S&P 500 companies listed this last quarter on their earnings report? We're seeing higher costs, right? We're seeing higher materials costs. We're seeing higher shipping costs and this kind of thing. Maybe that's starting to ease, and they have less less pressure on their own balance sheets. Apple came out with their new phones. They didn't raise the price. So I heard this, but I can't confirm this to be true, but I'll repeat it here anyways. I heard that the iPhone is the most profitable product in history. Again, I can't confirm that. I think that's interesting if it is. I know it is highly, highly profitable. Apple strives to make money on their phone versus the services derived from their phone. So just a big thank you to Apple for, padding their billions, giving us all just a little bit, saving $10 a phone and not raising the price, and instead.
Yeah, raise the price in this economy.
Exactly. Yeah. Appreciate you, Apple. You can carry that on your balance sheet for us.
Yeah, and also go back to housing. Just bring up another point about housing appreciation and just a different way to look at it. So cost of replacement, meaning we mentioned how much lumber costs, right? How much aluminum costs, copper costs. Those are all big components of housing. And if you bake in the cost of replacement, so that's an economic term. If you were to rebuild your home on the plot it was, what would it cost? So with all those goods baked in with how expensive they were in March, April, May, in the home appreciation during that time, home prices were only up 4% over the cost of replacement. So if you think about it, the cost of a home, one, was more expensive to build, so home builders had to sell it at, cost plus margin. That makes sense, right? So if your existing home, if you think about it as if you were Toll Brothers or KB Homes, and you were rebuilding your house and selling it, what would you have to sell it at? So that whatever your house was worth, consider the cost of replacement below that, and that's how economically we look at home appreciation. I know, again, if you look at your statement or look at the value of your home on paper, yes, you're making a lot of money in home equity because you're not rebuilding your home. That's crazy. But the cost of replacement is something that we, in the economics world, really consider because, one, you'll have to rebuild homes or build new homes to really gauge the cost of how things are appreciated.
It makes sense. And I've never totally thought about it like that. If you bought X number of years ago for whatever amount of money, you can't build it today for that same exact cost. So the replacement cost has an impact on the ultimate value because if something happened in the home, you would have to replace it. Therefore, it is worth at least that. You wouldn't replace it for $500,000 and sell it for $300,000 because you bought it for $300,000 10 years ago.
My insurance rep called me and was like, "Hey, the cost of replacement's gone up on the house. You're going to have to up
insurance.
Your coverage, right?" So if the home appreciates, it's kind of a nerdy economic thing to think about, but the home appreciation isn't just a free and clear appreciation, right? And the cost of replacement, if you needed to fix your plumbing, fix your electrical. My AC broke.
That's right.
It's 115 degrees here in Sacramento. My AC broke 2 days ago, and the cost of replacing your air conditioning, right? All that's up, right? That's a cost, and even though the home values come up, it reflects the cost of the components in the home.
But then we just talked about how the price of all these components of the home are coming down. So wouldn't that be then putting downward pressure on the replacement cost and therefore home prices?
Yep. And home prices, again, you mentioned 70% of listings have reduced their pricing. I don't think that's a coincidence. One, it's a supply and demand issue, but two, how severe are those price cuts? It's 4 or 5%.
Right? We don't have that data.
The data doesn't say. Yeah. But again, everything's trending in the right direction. This is like really encouraging.
And here's what I would add. So this is I know a lot of our listeners in the greater Seattle area, and so I'll quote this article. This is from the Puget Sound Business Journal. This was released yesterday, so September 8th. It says annual median East Side family home sales rose less than 4% in August. Seattle only saw about a 6% increase. Pierce and Snohomish County continues counties experienced hikes of less than 8%. What? This is good news. Like that's framed as, oh my God, things are crashing down. So it says Seattle area home market continues to cool, but experts say it's not the start of a bear market. Okay, so further, before rising interest rates started to tamp down the market, median sales price jumped over 22% on the east side, 11 in Seattle, 14 and 17 in Pierce and Snohomish counties, respectively. Okay, we can all agree that is not normal. It's awesome if you own, but it's not normal. And so seeing what is actually happening, this would actually suggest that prices are still ticking up a little bit, just a lot slower. And when you look at the long-term house appreciation numbers, you should be somewhere around inflation. Now, don't misquote me. Inflation at 8% should not be what you should expect on your home. Long-term inflation, let's say it's around 3, 4, 5. That's what you would expect somewhere around your home to appreciate. Homes historically are decent inflation hedges. And the U.S. likely wants to trend towards that 2 to 3% number again. We'll see when we get there. But anyway, I just thought this was interesting here.
I think that bears repeating is homes don't appreciate like up in a straight line historically. Like tamp down expectations in terms of how much home values jump in normal circumstances.
Yeah, exactly. Well, should we talk about the 529 plan?
I know you're dreading this part. So for the uninitiated, I think it was the few episodes ago where Chris admitted to holding off contributing to his newborn son's 529 college savings, and I asked him, to give himself a little grace because it's a normal thing, and what Chris did, we want to empathize with anyone who is in the same boat, same hesitation, and really go through his personal, experience with it, which is pretty awesome to live through.
Yeah, I had to embarrass myself there because of how perfectly this worked out, and actually right before we started the recording, I finally looked at this data, and so to roll the tape back, my wife and I meet monthly to have our family finance meetings, which is maybe something I can talk about in another podcast, what we cover and what we do there.
That's a good practice that a lot of people should do.
And so in this meeting, one of the topics was, hey, should we do a 529 plan? How much should we put in this year? Blah, 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 blah. And so we decide, yep, we want to do this, and, we want to allocate X toward this account, and let's do it. So we met on 7/17. It was a Sunday. And so, we made the decision, let's invest on that Monday, 7/18, simple as that. And that was the week where there was a lot of economic news coming out that, I thought, well, hey, maybe the market will come down a couple percent. I can get in a little lower, which, how, to your point, this goal is in like 2040. What's the difference of a couple of percent? But I said, well, I'll wait a week. And what happened was the market went up. In fact, 717, it wasn't the bottom or the near-term bottom. 616 was, as we know, as it today. So, but it was very, very close to it. I ended up waiting a whole month. And so on August 16th, I made the first deposit. Now, because the market had done so well, and for context, in between the day when I decided I was going to make the investment, so July 18th to August 16th, a month, the market was up 10.5%. So I missed 10.5%. So because things were doing so well, I decided to do half of what we were going to allocate. So, maybe it'll come down and I'll be able to average out my cost basis. Here's what's crazy. I could not have timed this worse. 816 was the top. 815 was lower and 817 was lower. 816 was the exact top. And of course, I finally threw in the towel, right? I just, maybe Howe's advice finally got to me. It's an 18-year goal. Just put money in. So thanks for that.
In 3-month period, that's bad advice because you lost this very
So
small
maybe
amount,
I can
guess.
give you some blame on buying at the high. Because I'd probably be still sitting on the sidelines. So anyway, so I buy at 816 on 816, up 10.5% from what I previously said I was going to buy, which I didn't do anything. I put in half. Then the market started to fall. So of course I was cheering. This was like great news for me. And I put in the other half of what I wanted to do on September 2nd. And in between August 16th and September 2nd, the market was down 8.5%. Okay, not bad, but it was still up 1.3% from the initial decision point. What else did I miss between July 17th and September 2nd? Dividends. I get into
Dividends
that,
income. Yep.
right? So this is funny, and thanks Hao, because in 18 years it won't matter, right? It's all going to be about the same. But I think the lesson here is just don't try to time it. We know this is what we say in our meetings, and it's funny. This is what we do for our clients. But of course, when it's then my own, it's like, well, maybe I'll wait a week and look at what happened to me.
Yeah. And I bet in his senior year, he's going to come back to you and say, hey, Dad, you know that time you missed that 10% swing?
The worst part,
That's going to cost me a chemistry
worst part
book.
about this is I'm still down on the whole account, right? Because I bought in at the high and then I bought in more at the low, and I'm still down. I have to look, but I'm down a couple of percent still because
Yeah.
yeah.
Can I ask about your plan? I was similar to you. We put a small amount right when my daughter was born. My son, not so much, but don't tell him this. Hopefully he doesn't listen.
I won't. Yeah. Yeah.
Are you planning to invest more? Or is that it was one of the lump sum?
We are. So I would say the general rule that we advise clients on, which we're, as you can imagine, we do what we tell our clients to do here personally as well. Our money's diversified in the same portfolio that our clients' money is in. It's all the same stuff. So 529 plans work sort of like a Roth IRA for education. So when you fund them with after-tax dollars, and then all the growth is tax-free. So if you think about what are some of the best opportunities to fund these types of accounts, it's when the markets come down, because you can simply buy more shares for that same amount of money in that year, and then likely things recover quickly. I know we talked about this in prior episodes, how when markets come down, you generally have volatility both on the upside or in recovery on the upside. So it's a good time to buy to get sort of actually a quick return over 6 to 12 months. And the other opportunity would be if you happen to be in a lower income tax year. So funding anything that is an after-tax account, if you're in a very, very high tax bracket, is expensive. If you happen to have, say, stock as a big portion of your income, which I know we have a lot of clients that work in technology, right? So if stock is a big portion of your income, and that company stock has also come down this year, you may pay less in taxes or have less of a percentage in taxes this year. And therefore, funding accounts that are after tax is cheaper this year.
We call that a tax holiday, right? Is that the right term?
We call that a tax holiday. Same thing on more of an extreme example of, let's say you're working for somewhere big tech, you leave, you do a startup of, say, your own, you're not drawing any salary for a year or two, and you have no income. That is a tax holiday that we love as financial planners, and we can knock out a whole bunch of different things, whether it's funding after-tax accounts, capital gains harvesting, because you're in a lower tax bracket, Roth conversions, conversations for another time. So anyway, that's our how 529s work, and our philosophy as a firm is we like to fund them early and at a high level. The contributions that you put in when your kid is 16 or 17 and then take back out at 18 don't have nearly as much value as the ones when they are 6 months old or 5 years old, just simply because they don't have as many years to sit in there and bake and grow and compound as they do at 17 or 18. So we like to take the total amount of money that you want to put in the 529, and if we can, and if it works financially for you, squish it into a couple of years and do it early.
It's if it works for you, right? Like, again, I want to be clear. We're not judging anyone who doesn't fund a 529 because, some parents prefer their kids to work.
Let me take it a step further too. So as a philosophy, I think one of the biggest concerns that we hear on 529 plans is, I don't know where my kid's going to go. I don't know if my kid's going to go.
If at all, right?
And I don't know what college is going to look like in 18 years. Is it going to be as expensive as it is today? Like, it's no surprise or no shock that the cost is going up or has gone up like crazy. Is that sustainable? So will there be material changes over the next 10, 15 years? And then when my kid goes to school, maybe it's back to a reasonable number again. So I don't want to oversave in this account that's earmarked for college. And because the risk of that is if you have excess money in that account, you've got to take it out, pay penalties, taxes, and yada, yada, yada. Our philosophy is still fund the account. If college is a goal and you want to set aside some money, still fund the account, do it early, do it often, and get it over with, and then just stop. And we like to target funding to around 50% of your actual goal, particularly if it's private school. Let's say you say, I want to pay for Harvard. If my kid goes to Harvard, I want to pay for the whole thing. We say, great, we run the numbers. And we generally would say, let's target whatever amount of funding it's going to require to get you there in the 529 to get 50% going to the 529. Why? Because what if Harvard's not where they go?
It's going to grow.
What if they go to a state school that is a significant amount less because
cheaper.
It's an in-state school?
Yeah.
We don't want you to have significant amounts of money inside of a 529 plan that you can't necessarily use.
You mentioned risk of overfunding. What are the other risks? Like, what are parents potentially giving up if they overfund?
I think if they're overfunding, so a positive to that, if from an affordability standpoint or an estate standpoint, parents don't want or need that money back, you can just leave it to the kids. So you can change beneficiaries on 529 plans, which is actually really powerful. You can change it to yourself. You could change it to another kid. You can change it to a grandkid for that matter. And so this could be potentially one of the most powerful vehicles to, let's say your kid's through school and you have $25,000 sitting in that 529 plan. Just let it sit until they have kids and pass it on. Imagine that, right? Imagine that, I don't know, 40 years of compounding. That's like the ultimate head start. Versus, I think most people have a kid, think about a 529 plan, and it's an 18-year goal. Imagine doubling that. So let me flip that around as, hey, what are the risks? Well, if you can afford to leave the money in there, it's not the worst thing in the world. It's actually a really nice thing. Yeah.
Yeah, and I know college funding, especially loans, is just like a third rail here. It's like such a dividing topic. And I think we wanted to really highlight Chris's personal experience, right? Because he has great advice on it and he's living it. And, there are a couple of things where, everyone's going to have a different opinion on it, which is fine. Let them have their opinion. It's your money. It's your kid's money. I think what we're encouraging is come up with some kind of a plan. And it's 18 years away in a lot of the cases, 10 years away in other cases. That's still a long time, right? And if you're waiting till 2032 for your kids to start college, right? Compounding, one, is one of the most important things that we do in investing. But two, in your case, have that discussion, right? What does debt look like with you and your family? What does funding look like? What does working through college look like? And there's no right answer, right? Chris and I had pretty similar paths to college, both state grads, but we know people who had their parents fund theirs, and that's fine. They had scholarships. That's fine too. Like, there's many paths up the mountain, but debt isn't the worst. School debt isn't the worst thing, especially if they're chasing really good major like engineering, and there's a high probability of success post college. But does that work for you? Does that work for your kid? Right? Does that work for future generations in your dynasty, I guess? And I think everyone is going to have a personal approach to it, and they should.
Let's come back to something you said there, because I think it's important. I feel like, don't know if it's just a societal thing, but I feel like there's sort of this almost parent shaming if you're not saving for your kids' college, or if it's not a goal of yours, you're not being a good parent. And I feel like I sense that sometimes in my meetings when I ask, what's your goal with college? And I feel like people are really just parroting what maybe came across the dinner table one time with some friends. And so it's like, well, my friends are doing this, so I want to do this because we're all kind of the same. And I would encourage folks to really take a step back and go, what do I really want to do here? Do I want to fund everything? Do I want to fund some? Do I want to fund none? Do I want to support in a different way? We have a lot of clients that say, I'm not sure what college looks like, so I want some of the money in a 529, but I want some of the money in a different account because maybe at that time I'm helping my child start a business, or maybe I'm helping them go through a trade school, or I'm helping them buy their first house, and maybe that's more impactful than just putting money in a 529 plan. So I would really
optionality, right?
I think it's taking a step back and really having a conversation as a family with a spouse, going, what values are we trying to instill with what we are saving for this objective? And then do what you want to do, not just what maybe society is saying that you at your income level with your asset level can do. I think that's more powerful. One of the questions that I ask people all the time when they say, hey, I will pay for, let's run the planet, 4 years of Harvard for my 3 kids. In fact, let's even be more conservative and let's run, what about 6 years for my 3 kids all at Harvard? And we run.
You're on the Hao plan, 6 years.
There you go. And we run the numbers, right? And it's a big number. And so I always ask, well, are you willing to work longer if all of this actually becomes true? If you do have 3 kids going through a very expensive school and you are shouldering all of it so that your kids can come out of this with no debt, are you willing to work longer if that's what it takes? And I think that's the most important question to ask. Some people are unequivocally, yes, I'll do anything. And that's okay.
Yeah,
There's
that's
nothing
fine.
wrong with that.
Yeah.
And some people, when asked that, I think they go, no, I'm not actually. And that's also fine.
Yeah.
And I think what I'm trying to encourage here is come up with what you truly want, not be biased or swayed by maybe what somebody else's values are.
Yeah. And if you're listening in the car with kids, like, I ask them to put earmuffs on. But if you fund their college, is there a way to get them to sign a contract to say they'll take care of you in your retirement years since you funded their livelihood, right? Like, you're sending a kid to Harvard, fully paid. That's worth something. More than love, I think.
Let's also talk about more downsides. So let me complete answering your question, because I took us down a different rabbit hole. So what are the other downsides of funding too much money to college, specifically too much money in a 529 plan? Is you might have to take it out later. And if you do that, you pay taxes and you pay penalties. There's a 10% penalty on the gain. You pay taxes on the gain as well. As I said earlier, you could roll it into another child. In terms of switching the beneficiary, you could just leave it in the account and leave it to your grandchildren or whatever, which is actually a really nice estate planning technique.
Can you put it into a name of the trust as well?
A 529 plan passes in an efficient way because it's a gift. So it's not actually in your estate. Okay. It's an out of estate asset. So if I put X dollars into my son's 529 plan, it is a completed gift. And when I die, it doesn't come back into my estate as a countable asset. And so for super, super wealthy people, you can super fund 529 plans. So let me kind of explain sort of some of the gifting rules here. So in 2022, you can put $16,000 into a 529 plan. It was $15,000 last year. So a lot of people have that in their head still. It's now $16. So I can do that into the 529 plan, and there's no tax, no gift tax, nothing. My wife can also do that into the 529 plan, all for one kid, one beneficiary. So we can put $32,000 into the 529 plan. 529 plans also allow for a super funding, which allows you to do 5 years worth of that $32,000 all in a single year. And in any case, if you do more than the 16,000, you should file a form 509 on your, 709 on your tax return, which says it's a gift splitting, and possibly you're spreading this gift out over that 5-year period. Why is this important? It's really only important in the event of an audit. And let's say that you did really super fund your 529 plan and you have a lot of money in there and you're paying for all of this college expense out of your 529, which you're then putting on your tax return as a tax-free withdrawal. What if the IRS audits you and they say, hey, can you just show us how you got that much money in the 529 plan? Because you're getting a really good tax-free benefit. That's when you would have to roll back to these tax returns and show, look, I filed this tax form. It's form 709. And the form 709 says I, put in the right amount of money. Once again, no tax on any of this stuff. It's just the paper trail proving how you actually put money into the account. Another note, let's say that you saved for college and your child gets a full ride somewhere. So you don't need any of the money. You can receive a waiver for the penalty portion of the 529 plan. So the IRS won't penalize you for saving for college because you didn't know that, your kid was going to be a tennis star and they got a full ride, right?
Also encourages families to still apply for scholarships, even if the kid isn't.
Good point. Yeah.
Honor roll student. There's so many different scholarships available. Any way you could chip away at the tuition tag, right? That's what we encourage. So apply and apply and apply.
I like it. Well, so in summary, we like to fund early and often and be done early because it's like a Roth. We like to target roughly 50% of a private school goal. We will go more than that on a public school goal. If you're in Seattle and you want to go to University of Washington or that's your goal, we're good funding 70 or 80 or even 100% of that because we feel like that's a low end of cost. One other thing. If you have 2 kids, we like 2 plans, 1 plan per kid. Why? Because you can easily change the beneficiary of one plan to the other kid, but you can't have 2 beneficiaries on one 529 plan. So having 2 separate plans, in other words, there's no downside. All the gifting rules that I explained earlier, you can do that per beneficiary. That's all well and good. Versus if you just had one 529 plan for your older kid, for example, you can't put in as much. You can't do that super funding as easily. And also you're just relying on changing the beneficiary later to your youngest, which if your kids are in school at the same time, you can't really do that. So 1 plan per kid is the best practice.
Great info. Thank you.
All right.
So I think that's our time today.
Awesome. Well, Thanks as always, and we'll talk again soon.